Hello, traders, and welcome to Simpler Trading. My name's Melissa, and I'm a trader here in the Trendy Trading Room and the SPX Room. We're so happy you joined us today. If this is your first time on the Simpler Trading YouTube channel, welcome to what I believe is the best community of traders out there. We have some of the absolute best traders in the market. We are dedicated to educating our members, pushing out great trade alerts, and just spending time together in a community. You know, trading can feel very lonely if you're not involved in a community of traders. I don't know about you, but most of the people in my life don't understand if I try to talk to them about the stock market. They are pretty clueless. But when you find a community of like minded people, it really makes trading a whole lot more fun, in my opinion. So I'm glad that you're here. I'm glad that you joined us. And I want to talk today about something that is very important in for me to be able to time my entries. I start every chart off with a buy and a sell zone. That's a buy zone. I'm looking for buyers to step in on a pullback. In the sell zone, I'm looking for sellers to step in on a rally. So every chart starts with those two zones for me. I use the inside and then up or down candlestick pattern. If you're not sure what I'm talking about, I have a video on my YouTube channel explaining that, so you can check that out. But going back to my buy and sell zones, today I'm mainly going to focus on what I do in a buy zone to help me from catching a falling knife. I don't know if you've ever experienced that, but in the past, I experienced it a lot. And while my account was still remaining positive, I found I was giving back just too much profit in the process of catching falling knives. So I came up with a plan to help me wait to get in a trade until I have some confirmation. And that's what I'm going to discuss with you today. What process I use to help confirm a buy is ready when price comes into my support zone or my buy zone. So, I'm going to shut my camera off here so that you can focus just on the slides. If you haven't already, be sure and give the video or this session a like and write in the comments if you have ever fallen victim to catching a falling knife. I want to see how many of you are being honest because I bet just about everyone has. And if you haven't, congratulations is all I can say. Hey, Anna Marie, good to see you. Thanks for joining me. All right, guys, let's get started here. If you're tired of watching your trading account bleed out from those frustrating false breakouts, you're in the right place. How many? Well, if my video will play, we're in good shape. If not, let's see. Let me try it again. All right, give me a second. There we go. Sorry about that. How many times have you jumped into a trade feeling super confident only to get stopped out within the first 15 minutes? Most of us have, right? It's not always because your idea was wrong. It's often because you got in too early, before the market really showed its hand. Professionals, they don't chase anything. They wait. They're looking for this one tiny repeating pattern, a subtle footprint that pops up on all charts, the higher low. If we can nail that, then you're suddenly filtering out all those annoying fake outs, writing the real moves, and actually tipping the odds back in your favor. So stick around because over the next few minutes, I'm going to walk you through the exact step by step checklist I use every single morning to spot these higher lows. We'll cover where to get in, where to place your stop loss without guessing, and how to scale out of your positions like a pro, all without that nagging second guessing. Fair warning, once you see this, I promise you'll never look at a pullback the same way again. It's truly a game changer. Let's be honest, most traders, especially newer ones, treat every single break of a trend line like it's a personal invitation from the market gods. They hit that buy button full of hope and then poof, price takes a tiny sneeze and they're underwater, often before the candle even has a chance to close. Ever been there? I know I have. Why does this happen so often? It's simple, really. They're confusing momentum with confirmation. Momentum, that fast, exciting surge, it's just energy. It's like a car speeding up. But confirmation, that's the evidence. That's the car actually stopping at a stop sign and then continuing its journey. So, what do I mean by a higher low? That, my friends, is your evidence. It's the market whispering or sometimes shouting that buyers are still in charge, willing to step in and pay a bit more on each dip. Think about it. If buyers are consistently pushing prices higher on pullbacks, who's left to sell? Mostly just those folks caught on the wrong side, the ones who will have to cover their shorts eventually, adding fuel to the next leg up. Without waiting for that higher low, you're essentially just gambling that you're not catching a falling knife. But with it, you're not just some retail trader chasing FOMO. You're entering alongside the big players, the institutions, when they're reloading their positions, not when they're dumping them on unsuspecting newbies. This isn't about being first, it's about being right. And often being right means waiting just a little bit longer. So, what does a valid higher low actually look like? All right, let's dive in. We need to define this saying so precisely that there's absolutely no room for maybe or it kind of looks like it. This is where discipline kicks in. We've got two non negotiable rules for a valid higher low. Miss one of these, and the whole setup is null and void. No exceptions, no wishful thinking. So, rule number one, the low, the actual lowest point of a pullback candle must print a higher price than the previous candle's low on the exact same time frame chart you're watching. So, for instance, if you're watching a 3-minute chart, you must compare the low to the last 3-minute candle's low. Don't go mixing time frames here. What I mean is, don't find a low on a 3-minute chart and then flip to a 2-minute chart to find the next low. All right. I do scale down my chart, but I'll get into that later on in the video. All right. So, no mixing time frames. That's a recipe for confusion. This tells you that fundamentally the market isn't willing to retrace as deeply as it did before. It's a sign of underlying strength. Then the number two rule, it's equally important. I wait for a break above the previous candle's body. No break above. I stay patient and wait unless any of the subsequent candles prints a lower low. Okay, so if I don't get the break above before a subsequent candle prints a lower low, I start the process all over again. All right. We want commitment, not just a flicker of interest. This combo, high or low and a break above, that's your golden ticket. It's evidence that the market isn't just taking a breather, it's actively consolidating before its next move up. Precision beats hope every single time, especially when your capital is on the line. So, looking at this example here, on this candle, we printed a low. Then the next candle printed a higher low. This third candle, waiting for a break above the body, did not happen, but notice that it still printed a higher low, so the trade is still valid. We get the breaking candle or the break above this body of consolidation right here on this nice big green candle. That, my friends, is the entry. That is when we have made higher lows and we have a break above. All right. All right. Now let me talk about how I drop down into a smaller time frame chart. I know what you're thinking. I'm looking at daily charts for trend, right? Because we always need to know what the current trend is. And 2-hour charts for structure. That's the time frame chart I use to find my buy and sell zones based on candlestick structure. So, how do I actually enter this thing? And this I'm focusing on when I am day trading using this process. That's where I get surgical. Daily and hourly charts are fantastic for giving you the overall market bias, for showing you the big picture, but they're just too slow for precise entries on a day trade. You'd be giving up too much profit or your stop loss would be massive. So once you've got your buy and sell zones mapped out on your chart, that's when you zoom in. So I'm going to drop down to the 5-minute chart for day trading. Then once price falls into my buy zone right here on this red candle wick, price fell into my buy zone, then, right, I'm going to move down to a 3-minute chart. So this is that candle that fell down into my buy zone on the 5-minute chart. Now I have zoomed in to a 3-minute chart, and this is where I'm going to wait and watch for the higher low first. This is where the magic happens. What you're waiting for here is a higher low than the previous candle. This shows you that the selling pressure is exhausting itself at that specific level. Buyers are starting to step in. It's like a tiny battle happening right at your key support level. Once you see that higher low, I want you to mark the body of that candle. So we see right here a higher low. We made this low at 239.40. The next candle made a higher low. I want you to mark the body of this higher low right here. Once this candle breaks above the body, that is my entry. All right. Now, where is my stop loss? Very simple. It would be a lower low. So my stop would go in right here at 239.40. And my entry was right here on the break of this candle's body. All right? Cool. By setting a stop as the lower low, this keeps my risk defined and small. Now, you might be asking, well, where is the target? Boom, right here. And I have videos to show you exactly how I find targets, right? Using the inside and down candlestick structure. So just know that I find the targets with a combination of inside candlestick structure as well as Fibonacci. Okay? The target, we're aiming for the next level of resistance on your chart. This single tweak, moving from guessing entries to this precise micro time frame confirmation, was what turned my profits around. It's all about precision and patience. Now, I use this same technique for my swing trades as well. The only difference is the time frame of the chart. So if I am swing trading from zones that I found on a weekly chart and price pulls back into my buy zone, then I move my confirmation time frame down to a 4-hour chart, meaning I'm watching 4-hour candles for a higher low and then a break above the body. If I'm trading from daily zones, then I'm going to use a 2-hour chart for confirmation. And 4-hour zones, I'll step it down to an hourly chart. Now I got to talk about the real enemy here. It's not the market, trust me. The market is just doing its thing. Your biggest enemy is that little voice in your head, the one that screams, "You're about to miss the train, jump in now." That voice, fueled by FOMO, can destroy an otherwise perfect strategy. So, how do we combat it? With a psychology checklist, just as rigorous as our technical one. First, a super simple yet incredibly effective trick. Put a sticky note on your computer. An actual sticky note, yes, right on your computer screen so that you have to look at it every single minute you're watching charts. All right. On it, I want you to write high or low plus break above question mark. And if the answer is no, then guess what? No trade, period. No exceptions. This visual reminder acts as a circuit breaker for impulsive decisions. It forces you to pause and check your rules. Trading is a mental game as much as it is a technical one. One more key thing that you must know is your position size. Know exactly how much you're risking before you even open your platform every day. This removes emotional sizing decisions in the heat of the moment. These tiny rituals, the sticky note and pre sizing, they work together to starve FOMO and feed discipline. Remember, the market will be open again tomorrow. It always does. But your account might not if you let emotion take the wheel and chase every perceived opportunity. Patience and discipline aren't just buzzwords, they're your superpowers in this game of trading. And I'm going to show you on a chart at the end of this video exactly how this one simple concept kept me from shorting the rally we're currently experiencing today. All right. Jomo or Jasper, sorry. Jasper, you don't care if the body after the higher low ends to the upside or downside, just as the next candle breaks above the body. Yeah, uh, Jasper, I take the candle break above the body. The only time I would be super conservative with that, Jasper, is if I were trying to go counter trend. And I know you know what that means, but there might be some people watching that don't know what I mean. And that would be in the example of today's market, and today is October 1st, 2025. We are in a bullish trend. So any trade that I would be trying to day trade to the downside would be considered counter trend. In those cases, I will err on the side of caution and wait and see if the break of the body indeed closes as a legitimate break and not just a fake out. Okay. Yeah, Jasper, I don't pay attention really honestly to the colors of the candles as much as I do the actual price action of the candle. All right? Let's move on now. Let's talk about some common pitfalls and how we can dodge them. Even with a solid strategy, the market loves to throw curveballs. There are some common traps that can snag even experienced traders if you're not careful. Knowing them is half the battle. So let's highlight a few and figure out how to dodge them. The first pitfall is confusing a higher low with a true continuation. What do I mean by that? Sometimes you'll see a series of higher lows, but each subsequent low is only microscopically higher than the last. It's barely, like barely a higher low, right? This isn't a real sign of strong buying pressure. It's often a sign that the volatility is dying out and the momentum is fading and the market is about to either set in chop or reverse. If each higher low looks weak, if the price isn't really pushing up with conviction, then I skip it. I want clear, decisive higher lows, not the ones that are barely there. All right. The second pitfall. Oh, I should mention in the first pitfall, a lot of times we have been waiting so long for a buy zone that price falls into the buy zone and we don't even wait for a higher low. I have fell victim to this more times than I can possibly tell you. So notice as price came in here, we never had a higher low plus a break above the body. We just continued and continued and continued to make lower lows. This is a trap because you get so excited to finally be able to enter a trade and then the market fakes you out. So you want to avoid that pitfall as well. The second pitfall is not waiting for that break above. A higher low is great, but if there's no break above before a lower low is created, then it's a no go for me. All right. And the third pitfall is this is a massive one. Not honoring your stops and doubling down on a losing trade. Look, we've all been there. You take a trade after following your rules, but price still hits your stop. You feel sick, probably even mad. And what do? You double down. You add a few more contracts, right? You over allocate. You don't stick to your position size rule. You over allocate because you have to make that money back. You think this one has to work. That's the market's way of taking even more of your money, guys. So please stick to your plan no matter how sure the setup feels. The moment you break your plan, the moment you let emotions dictate your position size, you've lost control. If you find yourself doing this, seriously, just turn off the platform and go for a walk. Clear your head. Re entry rules and position sizing rules exist for a reason. It's to protect you from yourself. Now, let's talk about managing your trade because getting into a trade is only half the battle. Managing it like a pro is where you truly lock in profits and minimize risk. This is about smart adaptive management. Know where your initial stop loss is first. I use a lower low as my stop when I enter the trade. So, here's your low, here's a higher low. Then you get your break above, right? This is your entry. The stop is a lower low. That is my initial stop on the trade. All right. Now, Now, you may be tempted to take every single setup you see, right? But I need to mention that risk to reward has to be an absolute minimum of 1 for 1 for me to take a trade. And ideally, I'm looking for at least a 1 to 2 risk to reward. If the distance from my entry to my stop is greater than the distance from my entry to the first level of resistance, I pass on the trade. It's a no trade for me. All right. All right. So now let's talk about how I move my stops up. Once price hits my first target, I'm going to take some money. I'm going to take some money from the market. Here is where I entered the trade. My stop would be a lower low, right? I've got a risk of about 3 points right there. And then my target's up here right around 9 points. When I get that first target, if I have multiple contracts, all right, I'm going to collect profits and move my stop to break even. This is very important. All right, because why? You don't want to let a winning trade become a losing trade. When you take profits at first target and move your stop to break even, your trade stays a winner in terms of capital. You've eliminated the possibility of a loss on that position, and that's a huge psychological win. Now, what happens when price really starts to run when it hits my second target? This is where I will use Fibonacci's. So I draw Fibonacci's from the move where I got in up to my second target. And I like to stay in the trade as long as the 38.2 fib holds as support. As price climbs, I simply move my fibs up, right? If I have multiple contracts, I take profits at each target and move my fibs up. Another common practice, if you don't want to use Fibonacci, is move your stop loss up to your previous target. So at target 2, you could move your stop to your target 1. At target 3, you can move your stop to target 2, and so on and so forth. This lets the market breathe, but also protects your profits. It's mechanical and removes emotion. At final target, I either continue trailing my stop or just take the remaining position off. This layered approach to management ensures you're protecting your capital, securing profits, and still allowing for those big winners to grow. It's all about defense first and offense second. Let me do a quick recap and then I will show you the example from today on SPX. So, the recap. Let's boil it down to a super actionable checklist. Print this out, stick it on your wall, make it your mantra. First and foremost, you must have your buy zones and sell zones marked and know where your resistance targets are at. This is your trade plan and it should always be your first step. Next, has price came into a buy zone? If yes, switch to a smaller time frame chart. Be patient, wait for a higher low to be made. Once price on the next candle breaks above the body, this is your entry. Enter the trade, put an alert at your stop, and then manage as explained earlier. Rinse, repeat, stay boring, stay profitable. This isn't sexy, but it works. Consistency over excitement. And this process also works when price enters a sell zone, but in a sell zone, we're looking to go short. And this time I'm waiting for lower highs and a break below. On any given day, I'm going long and short back and forth for the back and forth between support and resistance. Look, the market isn't handing out participation trophies. They reward two things: patience and precision. That's it. The higher low, this simple yet incredibly powerful pattern is the most objective, clearest confirmation you're going to get that buyers are still firmly in control. Master it, truly integrate it into your trading, and you'll stop gambling on hunches and start investing with a genuine statistical edge. Next time price goes ripping away without you, resist that almost irresistible itch to chase it. Don't do it. Instead, take a deep breath. Wait for the pullback. Wait for that confirmation of a higher low to print. Then and only then, strike with confidence and precision. Your trading account, and let's be honest, your blood pressure will absolutely thank you for it. Now, I said that I would show you my uh, example on SPX, and I'm a minute over, but I still want to show you this example from today on SPX and how I kept from catching a runaway train to the upside, right? So I had a zone up here on my 5-minute chart this morning that I knew if given the opportunity, I wanted to go short from this zone. And I've since removed it from my chart, but I want to show you where it was at. All right. Right here is the previous all-time high. Right here is the uh, inside and down candlestick structure. Okay. So let me go to a different chart because I'll mess this up in the day trade or in the SPX room. Here was the previous all-time high. We had an inside and down candlestick structure. This was a sell zone for me with confirmation. All right. And I take everything into account that I just explained before going short in a sell zone, especially on a very, very, very bullish market. All right. So this was my sell zone. Remember what I said. Number one, we have to have a good risk to reward. So when this trade set up, we we made a lower high right here on this candle. So the next candle I was watching to see if we would indeed make a lower high. We did, we did. This candle right here was the breakdown candle, but I want you to look at the risk to reward. The risk on this trade was over 3 points. Where was my reward? Well, the breakdown candle broke right into my reward. So, no risk to reward. It was not a profitable scenario for me. Even at my second target, right, would have been less than 2 points. It was a point and a half, and I had, remember, 3 points of risk. So, no trade. That saved me there. Then, if I go to the next time that I had the chance, it would be right here. We made this high. I'm looking for lower highs, remember? Okay. This is a lower high. This is a lower high. This is the break below. So on this trade, I would have been entering at 66.92, and 66.96 would have been my stop. That's a 4 point stop. But on this entry right here, when I had my fibs ran, I knew that my risk to reward again was not a 1-for-1 risk to reward. So I skipped the setup. Then on the next candle structure coming into this zone, switching to a 3-minute chart, I'll show you that again, no lower high. Boom. Broke out above the sell zone, made a new all-time high. There was no shorting to be done in that sell zone today. Some days there is, some days there isn't. You must use the complete process in order to really see if it is profitable for you. All right? All right. Thanks so much for joining me. Again, if you're new here, welcome. We're glad you found us. If you don't have a trading community to trade with, I invite you to join me and my trading partner, John, Trendy John, in the Trendy Trading Room or SPX room here at Simpler. There will be a link in the description of this video. I look forward to seeing you all in the next video. Have a great day.